You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp, the premier educational program for you out there in the retail trading world. Maybe you're thinking about dipping your toes into those options waters. Maybe you're one of the legion, the plethora of newcomers to the options market over the course of the past year. Maybe you're new to the show. Either way, welcome. We love you all here on Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever educational Options Insider Radio Network. A lot of great educational content on the network for you listeners. Of course, you have Bootcamp, still the premier place to go to learn about all things education. But if you need more in your ear holes, Options Playbook Radio, also on our double dose of education Wednesday here every week on the network. Mr. Overby holding court over there, educating you on various options topics and techniques. Of course, we do the strategy block a couple of times a week there as well on our option block program. So a lot of great educational content coming your way. How to get all that, of course, if you listen in just a boot camp, you got to subscribe to the full network. Get the whole kit and caboodle. Nearly a dozen programs coming your way. So if you're not subscribed to the full network, you're missing out on a lot of great options content. Of course, if you like what you hear, keep rating and reviewing it. It really does help all the newcomers to the world of options, and they are legion these days. Help all of them find a safe and reliable source of content in these troubled times. Keep those questions and comments coming. They are more important than ever, particularly for a show like this, where we're going to dive into a bunch of your questions. And joining me to help me answer your litany of questions, none other than Mr. Dan Passarelli, the founder of Market Taker Mentoring, the author of one or two or maybe six, maybe seven, I lost count, options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Good to be back, as always, Mark.
How many books are we up to now? 27, 42?
Close. Slight. If you round up to the nearest 27 or 42, yes.
Yes, round up. Always round up in the case of Mr. P. And we always round up to your questions. Let's get to them. A little bit of your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you folks take the reins You folks have been hitting us up left, right, and center. I sometimes feel bad making you wait a week or two because we have so many questions to get to. So we're going to try to get to as many as we can this week to keep you sated, keep your question asking needs sated here. That's what we're here for on Options Boot Camp. And before we do that, Mr. P, you get a lot of questions over there at the land of MTM as well. What is burning a hole in the brains of the MTM clients this week, sir?
Well, during our Trade Smart workshop, the last one that we had, we were talking about the stock repair strategy, which we might have talked about a long time ago on one of our episodes in the past.
One of my favorites, sir.
Yeah, it's a good one. And, it's one of those that only comes around just every now and then. It's not something that you've got three of them on at any given time. And I was going through my PowerPoint and probably using the old XYZ stock as an example. And somebody said, hey, Dan, what do you think about using this on ICLN, which is an ETF that I actually invested in back in January? And it ran into a little bit of trouble because I think it's because that ETF was heavily invested in Plug as their number one holding. But either way, it's down a little bit from its top. It's probably right around where I bought it right now. But I was like, yeah, that's a great idea. And I looked at it during class and I was like, holy cow, yeah, I'm putting this on tomorrow morning as soon as the market opens. And it's a very, very simple strategy. If any long-term holding that you already own has fallen anywhere between, say, 20 and 35%, if it's like a 5% move, just, suck it up and wait it out. If it's a 80% drop, then you got a whole nother boat of problems. But like if a stock you own falls 20 to 35%, you would buy what's called a 1x2, which is buying one at the money call and selling two out of the money calls. That's about halfway between where the stock is now and where the stock was when it started to fall. And you only put it on if you think that the stock can get up to that strike price, if it can retrace half of its move over anywhere between 2 to 6 months. And there's we can do like a whole episode on all the nuances to that. You've kind of got to get the timing right of it. And you want to try and do it for a zero credit or debit or as close to it as possible. But that's not necessarily a sticking point. And sometimes you have to go out further in time. And the one thing, and this has been a pretty common theme that Mark and I always have said on the show is, or at least I have in this way, the more you learn, the more you earn. And you should never stop learning. And that goes for everybody, including myself, because you learn when you teach. And I was going over that strategy in class. And I said, yeah, this is one of those where you just kind of have to get the timing right and you have to manage it. And, you have to not manage it. You have to just sort of leave it on and hold until close to expiration. And somebody said, well, but is there any possible way to manage it? And there actually is. And so the problem with the strategy has always been if it goes up too much, too fast, you don't make your money back and you're there, sitting on your hands waiting and hoping it just stops there and doesn't go any further higher or doesn't retrace and go back lower. But you can actually manage it and do some techniques where you just buy back those two short calls and you roll. I actually learned a lot about it the past week or so, just trying new things and learning as I teach. And that was really, really exciting because it's actually a way more powerful strategy than I originally thought.
Yeah, that's a great example of a fairly basic strategy. It takes a little bit of nuance too, but it's a fairly basic strategy that anyone can utilize in their portfolios, and a great example of a value added that options can bring. It's not that intimidating, listeners, once you get a handle on it, and it can help you in situations where you have taken a little bit of a drubbing in some of your stocks. So it's an interesting one to learn about. Check out our archives, listeners. We have talked about it at length in the past. Also, check out maybe some of our Options Playbook Radio episodes as well. I know Brian has touched on it as well. Maybe it might be time, Dan, for maybe a little bit of a stock repair refresher down the road too. What do you think?
Yeah, that you know what, like I said, we could do a whole episode on that, especially with some of these new things that I've explored with it. I've got like new things to share that I've never talked about before.
Ooh, new
It's
wrinkles on the stock repair. I like it. I like it. All right. I mean, maybe let us know what you think, listeners. Does that float your boat? Are you excited by Dan's new wrinkles on the stock? I know I'm kind of excited. So I think we might be touching on that down the road. Now let's get to what more of you have on the brain. Let's start off with a comment here from Tim. Tim King says, I'm with you and Dan on the minis thing. I think it's going back, Dan, to what we were talking about, our great mini options debate from a couple episodes ago. So I'm with you and Dan on the minis thing. They would be great, but it makes zero, all caps, 0 cents to replace the regular options with minis. Yeah, that's what a listener had suggested, that I think on a recent episode, that we should replace the regular options with minis. Dan, you and I didn't really agree with that for the reasons we espoused on the episode. Sounds like our listener here, Tim King, Dan, he agrees with us. He likes the minis, thinks they should come back, but doesn't make sense to swap out the regulars with the minis, Dan.
yeah. I think that's if I recall correctly, both of us sort of reached that conclusion as well. And the major point for that for me is keep in mind that adding another choice of options to trade doesn't divide liquidity. It doesn't disperse liquidity. If normal average daily volume is 1,000 contracts, and you add this other way to trade it, the minis, the average daily volume is going to become more than 1,000 contracts because of arbitrageurs who recognize, oh, these prices are out of line. I'm going to sell this one and buy this one. And so it's good for the liquidity of the underlying, again, if the exchanges and the brokerage firms work it out and make sure they take care of all those little details that ensure that it'll work, that it'll happen. Definitely not replacing anything, but it could potentially be a good addition.
Yeah, I think that's where we fell last time. I don't think we've changed since then. Minis, we'd like to see them back this year. Hopefully, that might be a good little poll to put out there to our audience. Maybe twist the knife a little bit on the rest of the industry to get them rolling on the whole minis thing again. Next up, we've got Lorenzo. Lorenzo wants to know, this is kind of related to what we were talking about on our last episode, Dan, with the whole beginners option strategies and how many positions. Lorenzo wants to know, what is the best time frame for beginner options trades? Is it 1 month? Is it 2 months? Thanks. Just discovered the show and I'm binging from episode 1. Well, welcome to the family here, Lorenzo. Enjoy that binge. You're not alone. A lot of people have written in saying, hey, I just learned about Options Bootcamp. I just discovered it. Just discovered these options things. And I'm going back to episode 1. I might need to go back to episode 1 and just check it out for myself again, Dan, see what the heck we were talking about back then. It has been a while since episode 1. People are sending me questions about episode 3 and 5, and I have to remember what we talked about back then. We've talked about many topics over these 100+ episodes out there. But welcome to the fold, Lorenzo, and everybody else who's joining the party here, new on Options Bootcamp. So, Dan, it's an interesting question. Lorenzo wants to know, what is the best time frame for beginner options trades? Is it 1 month or 2 months or something else? So when folks come to MTM, I'm sure you get this question all the time, especially these days. What do you tell folks when they're looking to trade options for the first time? What time frame are you leaning into, sir?
Yeah, I mean, I don't care if you're a beginner option trader or you've been trading for 20 years. The goal is to make money. So the ideal time frames are like, 1 day is too short, 2 days is pretty short, a year is generally too long, 6 months is too long. So, I mean, I don't know. I would say realistically anywhere from 3 days to 6 weeks. And I say that because you tend to get more liquid options within that period. You tend to get a better sort of Greeks scenario, better theta if you're selling options, better gamma if you're buying options. The vega is in sort of a nice sweet spot where it comes into play. It's not like too small where it's irrelevant like it is with 1 day options. It's not too big, and then IV doesn't move like it does with 1 year and longer options. So yeah, 3 days to 6 weeks is a really, really nice sweet spot.
Yeah, obviously it depends on what your outlook is, what you're trying to do, all these other things. But I'm with you, Dan. Absent all that other information, if someone comes to me right now and says, hey, what's your ideal starter position and time frame? I said it on the last episode, I like the covered call And I think, within that time frame you talked about, Dan, I like, a 1 month is a pretty simple thing for people to wrap their heads around. You get much earlier than that. You get into the weeklies, you have to trade a little bit more frequently. That could be a little bit much for a newcomer. You get beyond that, and you're right, Dan, liquidity dries up, gets a little bit. You want them to trade more frequently than maybe once every 6 months. So you get them out there on the monthly basis. It's easy for people to wrap their heads around. A 1 month covered call to me is like the ideal newbie starter position. It's simple, it's straightforward, it has a very clear time frame. You can wrap your head around it. Have it unfold over the course of the month. You can see how it works. Then you go on, you do it again. You trade it again the next month, and you can see how it goes. And then once you get a little bit more active, you can get a little bit more near term, start trading in the weeklies and things like that. But when you're just starting out, nice, clear, defined, easily understandable time frame, like a 1 month, makes a lot of sense. Next up, let's go to this one from Nate Davis. Nate wants to know, how is 2021 shaping up from an overall volume perspective versus 2020? It seems like it should be pretty strong. No? Well, yeah, you're right. Nate, it is pretty strong out there. You may have seen some commentary that maybe some retail volume is starting to trickle away a little bit, but those numbers are not being seen in the overall options market right now. Hot off the presses. We just broke these yesterday on Options Bootcamp, or I should say Option Block yesterday, listeners. So they're hot off the presses from our friends over there at OCC. The numbers are now out for March. And March, I think, spoiler alert, was a pretty darn good month. In fact, it was the best month in the history of the options business. Total cleared volume, OCC. Remember, they're the clearing firm that takes the other side of all your options trade. So they should know how many options are trading every month. They cleared 904 million contracts. It's the highest volume month in the history of the options business, up nearly 35% from March of last year, which was no slouch itself already. So we're talking serious numbers. It also brings to an end Q1, which was the highest volume quarter in the history of the options business. Year to date average daily volume. So how much volume is the options business doing on average every day? That was 42.3 million contracts, up nearly 50% from March of last year. You drill it down a little bit further, you can get into equity options. 856 million of that was equity options, up 45%. ETF options, that was 269 million, up 11.2%. Actually, excuse me, that was actually down. That was one of the few dark spots, ETF and index options. ETF options down 11.2%. Index options, 41.7 million, down 42%. Index options have not been the bright spot in this. And also futures. People not trading a lot of VIX futures anymore because that's 5.3 million contracts, down 31%. But overall, Dan, March roaring in and going out like a lion this year, blew away December, which was at the end of last year the most active month ever, and indeed January, which was also coming into March, was the most active month in the history of the options business. So I think we have March is number one. I think January is number two. And I do believe February is number three. So the top three most active months in the history of the options market so far in 2021. I don't think anyone really predicted this. A lot of people thought 2021 was going to be a much quieter year from an options front, but at least so far, Dan, not so much, sir.
Yeah, I don't know. I think that options volume is probably a little bit here to stay. Listed originally in 1973, it took them almost 50 years to get like completely, totally mainstream, where like half the 22-year-olds that are trading them, and it's great. Like you and I have been telling people for years, like this is such a great vehicle. I mean, my whole thing is I tell people, look, like this is what levels the playing field between just the retail investor and the professional trader. Like you have access to the exact same tools that they do, and it's such a powerful tool. And yeah, I'm so happy about it. I just feel that so many people got the exposure to it that they understand them better. There's not like this dumb like fear like anybody who says, oh, those derivatives traders, they're terrible. Like now people realize what options actually are, and they can say, no, like you don't even know what you're talking about. So yeah, I think that we're here to stay with volume. I mean, sure, it could ebb a little bit from here as people go back to work, but I think the boost that we got, we're in high water territory from this point forward. We're not going back to where it was in 2019.
Yeah, that structurally, the amount of penetration that options have gotten in audiences and markets that I never thought really would penetrate that far into over the course of the past year has really been remarkable. It's hard to say that there really is any winner in a period of global pandemic when there's such horrible misery going on around the world. But if you had to pick a winner from the pandemic, the options market might have to be up there in terms of just how much volume, how much attention, how much interest turned to it over the course of the past year, beyond levels anyone thought was any time in the near future we'd ever see. So interesting stuff. Yeah, it's, I think, short answer to your question there, Nate Davis. It's shaping up pretty darn well. All right, move on out. Dan, this is a couple of questions from our recent episodes. We did the whole debit versus credit spreads. I had a feeling this would prompt some discussion, and it has. The first question comes from ZDL. They're saying, so there isn't a higher probability for credit spreads than debit spreads. I thought that was pretty much understood. I'm confused. And then we have a related question here or a comment from Gilbert's, or maybe Gilbert S, saying, I only sell credit spreads. I'd much rather collect than pay for my trades. Plus, they tend to be more profitable over time. Dan, this goes back to, I think, what one of our questions we had when we were talking about the debits versus credits. There was this kind of assumed inherent higher probability of one versus the other. We kind of debunked that on the episode, but maybe we should clarify that for people again here on the show. What the heck we mean when we say this whole debit versus credit spreads, there really isn't a probability difference, sir.
Yeah, so it's really important to understand one simple point. And when I said last time that debit spreads and credit spreads have the exact same, well, basically the exact same probability as well as payout structure, I was specifically talking about debit spreads and credit spreads sharing the exact same strikes and the exact same expiration, which in practice may or may not be how you trade them. So I can draw a parallel here and say, do all calls have the same probability? Well, no. If I buy a way far out of the money call or a way far in the money call, those are two different probabilities and two different payout structures, two different risk rewards. So it's the same here. If I'm looking at the 70-75 bull put spread or the 70-75 bull call spread, both in the same expiration, those suckers have the exact same probability and the exact same payout structure. When I say exact, we do have to account for American exercise and interest in a couple of things, but basically exact. Now, so I'm glad that these questions are paired right next to each other. So from Gilbert's here, he says, I'd much rather collect money than pay for the trades. Plus, they tend to be more profitable. They probably tend to be more profitable because you're selling out of the money credit spreads that just are starting out with a greater likelihood of winning if you use delta as an estimate for the likelihood of an option expiring in the money. Whereas, if you were to compare that credit spread to a debit spread there with the same strike prices, you're kind of doing something a little bit different there. You probably wouldn't be buying an in the money put credit spread with both options in the money. It's just not a common thing to do. So I hope both of you guys, ZDL and Gilberts, see that really, really important difference there. There tends to be a difference in practicality in how we trade those. Typically, credit spreads, both options are out of the money. Typically with debit spreads, either both options are out of the money, the long's at the money, or the long is maybe in the money, but the out is certainly always out of the money. So you're almost never going to be comparing the same strikes for a put credit spread and a call debit spread. I hope that makes sense to you guys if you're listening today.
Yeah, people get confused about this, because they usually trade out of the money options, and that's how they think of debit versus credit spreads. And like, oh, if I buy an out of the money debit spread, that's probably not going to work out. The probability is against me. Whereas I sell an out of the money credit spread, is probably going to work out for me because the probabilities are in my favor. And yes, you are correct. That's not what Dan and I were talking about. Dan and I are talking about the same exact strikes. So we talked about in our examples, right? The XYZ trade out there where you're at the money, and then $5 out of the money. That was our vertical call spread. And then we did the same on the same exact strikes with the put spread as well. And again, this is not a scenario most people encounter because as Dan pointed out, you're probably not going to trade an in the money spread on one of these. You're probably going to look at out of the money. But you're looking at exact same strikes. That's what we're talking about, with things being synthetically equivalent from a risk perspective and indeed from a probability perspective. No difference. But if you're getting an out of the money spreads, yeah, if you're buying lower probability out of the money spreads, yeah, it's probably not going to work for you in your long run, versus selling them probably going to work a little bit better. So yeah, that does make sense from that perspective, but that's not what we were talking about. So go back, listen to the episode if you are confused. Next up, we've got the barista. I wonder what he does, or perhaps she, for a living. They want to know, hello, love the program. Well, we love you back, barista, and everyone else takes the time to write into us here. Says, been listening for a bit and heard the back and forth about what happens when puts expire. Yeah, that was a few episodes back as well, I believe, our whole discussion about what happens when a put expires. There were some misperceptions there in our audience. So the barista goes on to write, you also explained cash settled options, and that one confused me a bit. Allow me to ask one clarifying question. So if I'm long a $5 put spread in a stock that expires $3 in the money, will I simply receive a $3 credit for the trade at expiration? Dan, what's one of the things I love about doing this show is because you discover maybe sticking points or pain points in the world of options that you didn't really know about. Because, for you and I, we've been doing this thing forever, exercising of puts and settlements, not an area we come back to a lot because it's one we've done in the past and we learned about many years ago. And for us, it's not a pain point, but we see it from the audience that clearly there still is some confusion, Mr. P, around the world of what happens to a put when it goes to expiration. Now, we talked about when it goes in the money on a traditionally physically settled, where you get the underlying type product, so your Apple options and that sort of thing. You get a short position in the underlying. And if you sold that put to someone else, guess what? You're going to get a long position in the underlying if it expires in the money. But Dan, here we're talking about cash settle, which we also broke down on the show not too long ago. Maybe a little bit simpler for people to understand because there's no risk of underlying. It's just kind of debits and credits moving around in your accounts. Why don't you clarify it, I should say, here for the barista. Wants to know if he has this $5 put spread, it expires $3 in the money in a cash settled option here. What the heck happens, Dan?
Yeah, the barista. In this case, for a typical retail trader like you're describing, it simplifies the whole darn process because you don't end up with, a short stock position. You just end up with the cash, basically the intrinsic value of the spread, and boom, 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 you're out, you got the money, and you move on, and everything is great. And so in a lot of ways, it reduces risk there, because if this were stock settled or underlying settled, if it's an ETF or something, then you would have to worry about, oh crap, am I going to come in Monday, like the long puts in the money, but the short one's out of the money. If I just leave this held through expiration, I'm going to end up with a short stock position. So I got to trade out, or I got to figure something out. So in a lot of ways, it simplifies and takes away a lot of risk in some scenarios. Though in some scenarios, it complicates and adds risk. Like for market makers and other arbitrageurs who actually hedge all their positions, if they are to hold something until expert, and especially in options like SPX, where the settlement is last trading day is Thursday afternoon, settlement is based off Friday morning, market makers can run into big trouble if they're making the assumption, oh, hey, these are in the money, and so I don't have to worry about them because I'm hedged, and then it moves overnight and opens Friday morning and they're out of the money. Then all of a sudden you've got these futures and you're like, oh crap, I've got a bunch of deltas now. So, it's different. Make sure you pay attention to the nuances. Almost always for retail traders, it's simpler and cleaner and less risk. But just kind of try and think through, what happens. And hopefully my explanation here makes you more able to do that. But, just kind of always think through what happens if I hold this to expiration. And as we always say on this show, you can solve any problems as to what happens at expiration by taking the darn thing off before expiration.
Yes, that is always the case. Well said, sir. All right, we're coming up against it. We got time. Let's see if we can squeeze in a few more here, Dan. The people want their questions answered. That's what we're here for. Next up, we got James. James Lovall says, "Hi, Mark. Huge fan of the network. I have an options question about a move that I can't make sense of. A GSX is one of the stocks that was crushed by the Archegos debacle down to about $34 a share. 4,000 contracts look to be bought at the 100 strike for May expiration. They were purchased on March 30th when the stock was $34.44. Why on earth would someone put approximately $26 million down to buy a deep in the money put and $600,000 for out of the money calls? I have been running through different ways this would be used, but I'm stumped. Keep up the great work. You guys are a trusted source of info in a sea of misinformation and bad ideas." And thank you very much for the kind words there, Jamie. This came in during one of our other shows, and I had a chance to pull up the trades in question, but I thought it'd be worthwhile to talk about it here as well for some of our listeners who are confused about this kind of stuff. When I heard his question, my initial thought was, okay, this is probably just a conversion reversal, which is effectively a synthetic underlying type trade. Listeners, if you don't know what that means, synthetics, all that other good stuff, go check out our archives of this show. We got into it back in the early days of the program. That pretty much seems to be exactly what happened here, James. In fact, it wasn't May. They were actually July. I found the trades you were talking about in question. It was the July par, aka 100 puts, going up 4,000 times for 67.29. And then 4,000 as well of the July 100 calls going up for $1.59. And so they bought the puts and they didn't buy the calls. That's the first mistake there, James. They didn't buy the calls. Otherwise, you're right. That would be kind of crazy out there. But they sold the calls. And so what you're doing at that strike then is effectively you're doing what we call a conversion reversal. Remember, if you're buying a put, deep in the money put, selling a call on the same strike, you're getting effectively short the underlying. If you look up GSX, you will see, hey, it's short sale restricted. So it's hard to sell that stock short using the stock itself. So a lot of times people will go and try to source that liquidity in the options market itself. So they did that spread. They bought the put, sold the call. They did it for $65.70. And if you go look at this print where the stock went up for it, because they did this trade tied to stock for $34.42. And so let's do some basic math there, of course. Now you got 35, so you're talking 34.30 is what they did. Remember, 100 strike minus 65.70 is what they paid for it. So they did the stock position effectively for 34.30, but we know where the trade went up. The stock was 34.42. So they did that quote unquote conversion reversal for 12 cents. What this is effectively a way to synthetically adjust some of your positions out there. You're buying a short position in the underlying out there, buying the put, selling the call. So you're getting a short there. You're doing it against a position in the stock. So it's allowing you effectively to adjust some of your short stock position, short stock exposure out there. Don't get hung up on the strike. The strike doesn't matter. They can do these conversion reversals, synthetic underlying on any strike, 1,000 strike, 50 strike, doesn't matter. It looks outlandish because it's the par strike. I agree with you. That's why it caught your attention. But these are effectively just underlying type equivalent trades. It's done to manage your stock, your underlying position at the end of the day, allow you to get some exposure maybe you can get or you can't get in the stock through using the options. But this is not, don't look at this as some sort of great economic intent. They're not coming in here trying to trade the 100 strike, thinking GXX is rallying back there anytime soon. Anything you want to add, Dan, on this whole conversion reversal scene and whether listeners and traders should pay attention to these, sir?
Yeah, I mean, I kind of want to step back and go big picture, look at the forest, not the trees a little bit. Like, bear in mind, like, this is something that I've been studying a real lot lately. Bear in mind when you see orders trade, there's $600,000 worth of out of the money calls, 10,000 calls or whatever it is. When you see them trade, it doesn't necessarily mean that somebody is opening a new buying position because they're bullish. Like, it doesn't necessarily mean that. And same thing with extremely deep in the money puts. In fact, most of the time with extremely deep in the money puts, it's an arbitrage type scenario, like an interest type scenario. And that could have been like market maker to market maker. Somebody wanted to get shorts, long stocks so that for whatever, like there's a whole bunch of different reasons why somebody would do this. One market maker sells 5,000 deep in the money puts to a different market maker, and they do it tied with stock with 100 delta. So there's no risk to the trade, but one just wants to have the long stock in their account or the short stock in their account to earn interest on it. Like there's so many different reasons. So don't get tripped up by saying this many things traded. That means this is happening. Now, that said, I am a fan of using what is sometimes referred to as unusual activity, but you've really got to look at what's going on. Like, first of all, is it an opening or a closing order? Second of all, is it a buy order or a sell order? Third of all, is it part of a spread or not? Fourth of all, could this possibly be a hedge? Like, there's so many bits of information. Don't just look at the surface. You got to dig down a little bit. And when you do, you might be able to uncover some really great trading info.
Well said, sir. We're kind of up against it, Dan, but let's be nice. Let's give the folks one more here. I just like this handle, Big Fig. What do we have? We had the Big Bob before. We had the Barista. Now we got Big Fig. A lot of B named listeners on the show today. Big Fig wants to know, I understand that options can go to zero more likely than a stock can due to complications like an expiration date. Yeah, that expiration date does tend to hang over things, Big Fig. He goes on to write, so I get that I can lose my entire investment with options, but are there any scenarios where I could lose more than my entire investment? Yeah, there are. There are a variety of different scenarios. Usually gets back to what we talked about on the show before, people getting maybe a little bit over their heads in terms of what they're doing. Typically involves usually having multiple leveraged short legs against your long position, where if you move aggressively in one direction, so let's say you buy a ratio put spread, listeners, right? So now you're buying a spread, so you're doing a debit, you're paying for it. You might think, well, I bought it. That's all my risk, right? But if you bought one, let's say at the money put in XYZ, and you sold two or maybe three, $5 out of the money puts at XYZ, and it's trading at 100, let's say, and it drops, you sold those two or three puts at 95. Now you start breaking through that strike. You get aggressively down. Let's say you get down to 85. Guess what? You're losing money on that trade. And it's not just limited to the risk of what you pay. Let's say maybe you paid 50 cents for that after all the credits are taken in for selling the puts there. You still end up paying 50 cents. You're not limited to your risk there, 50 cents. You could lose a lot more. The underlying keeps dropping. You're going to lose a lot more because you have what we say on the show. It's your net short units in one direction. That could end up coming back to bite you. That's the most common scenario, Dan, where people, they pay money for a trade, but then they're net short units and it comes back to bite them. Is that what you typically see as well? People have these kind of ratio type spreads on, and that's where they end up getting bit in the end? Or are there other scenarios you see where people come in, they think they're limited to the amount they spent on a trade, but they end up losing more?
Yeah, like I am a huge fan of, as soon as you start learning about options, the first thing you should learn how to do is train yourself to draw an at expiration profit and loss diagram with a pen and a piece of paper. Old-fashioned way. And if you don't know how to do that, I'm going to send you right now to my website, markettaker.com, and just click on join free, and I've got a free tutorial on there that shows you how to draw any profit and loss diagram. If you do that, you will see the times when there is, unlimited risk or greater risk than what you invest off the bat, and when you do indeed have limited risk. So do that. That will take you a long way. It can save you some extremely unpleasant surprises down the road.
All right, everybody. That music means we've come to the end of this sojourn through the world of options education. Love your questions. Keep them coming. You guys pull us in so many different directions, which is fascinating for us because it gives us great content for future episodes. We've already talked about maybe doing a stock repair type episode coming up. We've done many episodes already based on your feedback, on your questions. If you have a topic you want us to discuss on the show, a question you like answered, you know how to find us. At Options is the easiest place. Most of the major social media platforms. You can also go to our website, hit us up with questions at theoptionsinsider.com. All of that works. If you use the rating and review systems like the iTunes or the Apple Podcasts or for the App Store where you get our app, those are usually a little bit slower. We don't get to those in as timely of a basis. If you want to hit us up, the best places are the social media, the website, the email. Those are the most timely ways to get your questions answered, your topics considered here on the show. Mr. Dan, if folks have elaborate options questions they want perhaps answered in a more one-on-one type scenario, where should they go? What should they do?
Yeah, make your way over to my website, again, markettaker.com. And if you do think that maybe some sort of one-on-one scenario would be helpful, we can book a strategy session with our trader success team. No obligation, no cost or anything like that. Just go down to the footer and click on free strategy session. And they'd be glad to talk to you, see if a one-on-one coaching scenario makes sense for you. And if it does, great. If it doesn't, great too. But hey, look, bottom line is we're here to help. That's what we do over here.
There you go. Check them out. Market Taker Mentoring 2Ts.com is the place to go. On behalf of Mr. P and indeed myself, thank all of you out there for downloading, streaming, subscribing, for listening live. And we'll see you back here next Education Wednesday, another episode of Options Bootcamp.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.